Here's the headline they don't want you to think too hard about. China is quietly dumping U.S. debt. Trillions of dollars are on the line, and the real danger isn't what's happening today. It's what this move tells us about tomorrow. Because this isn't just about bonds, it's about power, trust, and who's preparing for a financial world that looks very different from the one we know. For decades, one simple idea sat at the center of the global financial system. The United States borrows, the world buys. U.S. Treasuries were treated like cash with a yield, safe, liquid, untouchable, and no country embraced that system more aggressively than China. By the early 2010s, China was sitting on more than $1 trillion in U.S. government debt, effectively financing America's deficits while locking its own currency strategy to the dollar-based system, but that relationship has been changing. Slowly at first, then unmistakably. Recent data shows China continuing to reduce its treasury holdings, selling off billions more and pushing its exposure to the lowest levels in well over a decade. On the surface, this looks technical. Portfolio rebalancing, currency management, routine adjustments. That's the comforting explanation. The problem is that it doesn't explain the timing, the persistence, or the direction. This isn't a one-off sale. It's a long, steady exit. And when a major creditor chooses to leave quietly rather than loudly, it's usually not because they're panicking. It's because they're planning. Ask yourself a simple question. If U.S. debt is still the safest asset on Earth, why is one of its largest historical holders consistently reducing exposure while geopolitical tensions rise, sanctions become a standard policy tool, and the U.S. runs trillion-dollar deficits as far as the eye can see? China isn't selling because it needs cash. It's selling because cash, when frozen or weaponized, stops being safe. Over the last few years, the global financial system learned a new lesson. Reserves aren't neutral anymore. They can be seized, restricted, politicized. For a country like China holding massive amounts of U.S. debt now comes with a risk that has nothing to do with interest rates and everything to do with control. And here's where most coverage misses the point. China isn't abandoning treasuries because the U.S. is about to default. That's not the signal. The real signal is that China is actively reducing dependence on a system it no longer fully trusts, because trust, once cracked, never breaks cleanly. It fractures slowly, then all at once. China has been watching the U.S. financial machine up close for decades. It has watched debt ceilings turn into political theater. It has watched emergency money printing become a normal response. And it has watched interest on the debt explode as rates rise, turning yesterday's cheap borrowing into tomorrow's fiscal burden. From China's perspective, U.S. Treasuries no longer serve just one role. They are no longer only a reserve asset, they are now also a geopolitical exposure. Holding them means being tied to U.S. policy decisions, U.S. sanctions, and U.S. political exposure. Holding them means being tied to U.S. policy decisions, U.S. sanctions, and U.S. political risk. Selling them, slowly and carefully, means buying optionality, flexibility, insurance. Notice how careful the exit has been. China isn't flooding the market. It's not trying to crash treasury prices. That would hurt China as much as anyone. Instead, it's reallocating. Shorter maturities, more gold, more bilateral trade settlement outside the dollar, more regional influence through development banks and currency swap lines. None of these moves make headlines on their own. Together, they paint a very clear picture. This is not about running away. It's about repositioning before the rules change, and those rules are already changing. The U.S. now relies on domestic buyers and the Federal Reserve far more than it used to. Foreign demand for treasuries is weaker than in past cycles, even as supply explodes. Someone still has to buy the debt. When foreigners step back, yields rise. When yields rise, interest costs balloon. And when interest costs balloon, policy choices narrow fast. That feedback loop is the real risk signal here. China stepping away doesn't cause the problem. It exposes it. It forces the system to rely more heavily on itself. And systems that must self-finance indefinitely tend to show stress eventually. There's another layer that rarely gets discussed. By reducing treasury holdings, China also reduces its vulnerability to financial retaliation. If relations deteriorate further, fewer assets are sitting inside a system that can freeze, block, or pressure. That's not fear, that's strategy. So when analysts say, this doesn't matter, markets absorb the sales just fine, they're missing the deeper story. Markets can absorb flows. They cannot absorb meaning. And the meaning of this move is that one of the world's largest economic powers is preparing for a future where the dollar is still dominant, but no longer unquestioned. That preparation isn't loud. It isn't dramatic. But it is deliberate. And it raises a much bigger question about what happens next when others quietly start doing the same thing. and the system discovers it has fewer true believers than it thought, leaving behind only buyers of necessity rather than conviction. Because conviction is what makes a reserve system stable in the long run. Once participation becomes forced instead of chosen, the math starts to matter a lot more. This is where the story comes back to the United States itself. The US can still borrow. It can still print. It can still fund deficits. But it can no longer assume unlimited foreign appetite at any price. That assumption underpinned decades of policy decisions. When it weakens, every new $1 trillion of debt becomes harder to justify and more expensive to service. China's exit is not a warning siren, it's a temperature reading. It tells us the system is heating up. Higher yields are already reflecting that. So is the Federal Reserve's quiet role as buyer of last resort whenever stress appears. That dynamic works in the short term. In the long term, it creates a choice. Either fiscal discipline returns or financial repression fills the gap. And for investors, this shift changes how risk should be understood. U.S. Treasuries may remain the deepest market in the world, but depth is not the same as safety. Safety depends on confidence, and confidence depends on behavior. When large, patient players choose to step back, it's worth asking why. China isn't trying to dethrone the dollar tomorrow. That narrative is too simplistic. What it's doing is far more subtle. It's building a parallel set of options, so that if the current system becomes unstable, it isn't trapped inside it. Gold reserves rise. Trade bypasses traditional channels. Financial infrastructure becomes more regional, more fragmented, and less centered on a single authority. History shows us how these transitions usually happen. Not through collapse, but through erosion. Not through headlines, but through balance sheets. By the time everyone agrees the system has changed, the change already happened years earlier. So when you see another report saying China sold more US debt and markets barely reacted, don't mistake calm for irrelevance. Calm is often what strategy looks like when it's working. This sell-off isn't about panic, it's about preparation. And that brings us to the real takeaway. The global financial system is entering a phase where trust is no longer assumed. It has to be earned continuously. Countries will diversify not because they hate the dollar, but because relying on a single pillar in a fractured world is no longer rational. China's US debt exit is a signal, not of collapse, but of adaptation. A reminder that power in finance doesn't shout. It rebalances quietly. And the country's institutions and investors who pay attention to these quiet moves will be far better positioned than those who wait for a crisis to explain what was visible all along. The story here isn't about China selling bonds. It's about a world learning to hedge against certainty itself. And once that mindset takes hold, the financial landscape never looks the same again.